Well, I'm excited to get us kicked off today with our Keiretsu Academy series, which continues. We do highlight different topics. We try to do this on a monthly basis, topics that impact us as investors day in and day out to help us provide more education, more knowledge, and then bringing some of that mind share together as well that we just so value here with the Keiretsu Forum. Today's topic will be on cap tables. Now, this topic comes up all the time. We hear investors talking about cap tables and deal structure and the different screenings and our forum meetings. But what does it all mean? And what does the math mean? And why is it important? And how does it affect us as investors? So I'm really honored today to bring forth Nathan McDonald, who has been working in this industry for over 20 years. And one of his specialties is actually deal structures. And a lot of the times these companies, before they present, their structure needs to be fixed and the cap table needs to be looked at and addressed so the company can be fundable with the different vehicles that, that they're moving with. So really taking that into account. So Nathan is going to be sharing some of his thought leadership today around cap tables, some of the basic things as well. Nate Foos will, who also is one of the managing partners with our Keiretsu Capital Fund, will help finish us off today talking about the term sheet evaluations and dilutions. We have Joe Wallen from Carney Badley Spellman joining in to discuss a little bit of the overview up at the beginning. So thank you, Joe, for being in. We always appreciate all the work that you do. And Carney Badley Spellman is one of Keiretsu Forum sponsors and our corporate counsel for our capital fund. And then we'll be also joined by Francisca. And Nathan, please help me with her last name, Cuccinelli. Did I say that correct? To talk about Carta, which is a platform that has been growing rapidly, but it helps us with our electronic cap tables and helping us as investors stay organized, also helping the companies stay organized as they continue to bring on funding. So without further ado, I would like to turn the meeting over to Nathan to kick us off today. So Nathan, the floor is yours.
Morning, everybody. Great to have you on. Thanks for those of you joining in from across the country. Joe and I are going to kick things off with just kind of some 101 level, what is a cap table? And we've got some questions just on kind of the legal side and some experience from his many years in corporate counsel working with companies. Obviously, a lot of the legal work does revolve around the capitalization of the company. Then I'm going to run through a section on valuation, which is pretty important for us as investors, is understanding the value of the cap table, the different parts of it, and how those relate to each other. And then we'll take a little sidestep at about 11:30. We have Francesca coming on from Carta, as Brianna mentioned. There's been a lot of innovation in how cap tables are managed over the last 5 to 10 years, and Carta is one of the companies at the leading edge of that. They also had all of our fund administration, and they're just recently launched the Carta X platform, which is a secondary market for private investments. So pretty excited to have them on as a strategic partner with Keiretsu to share about where cap tables are going in the future and what we see as the opportunities to create a more liquid market down the road for private companies. It all comes down to the cap table and having electronically transferable shares to really reduce a lot of the friction there. And then at the tail end here, we're going to go through dilution of the cap table. That's also a big topic. And it's one of the key things for due diligence is how much further funding are these companies going to need, because the dilution risk, especially with the valuation we're investing today, can be very acute if we don't understand those downstream financing rounds and how that's going to impact our investment today. And then we love your questions. Please submit any questions into the chat window as we go through the presentation today, and we'll try to get to as many of the questions as we can throughout the presentation. We love to keep these very interactive. So we will start off around the 101 level, and then we'll work our way up to the 201, 301, 401. So for those of you who are brand new to angel investing, some of this will be getting it started. And then for those of you who are a little more experienced, some of this may be a little elementary here to get it started. But I think it's always good to give everybody just kind of the ground up sense for what we're talking about when we talk about a cap table, a capitalization of a company and the holders. And so, Joe, if you want to come in here, I've got a few questions for us just to kind of kick off the discussion and give everybody kind of a baseline of, what is a cap table? So if you want to just, what is the legal definition of a capitalization table, and kind of any background on kind of where that came from, and then we'll kind of work through the questions here that I've got a couple slides worth of just kind of basic questions for you to run through for the group here, just to kind of give us a baseline.
Sure. Thanks for having me. Delighted to be here to talk to you about this. I talk about these things all the time to founders and investors. So anyway, fun to be here. Yeah, there's some misnomers that float around about what a cap table is. And all a cap table really is a reflection of the underlying legal documents that have been executed. And so it's like a shadow of the thing that actually is, if you want to think of it that way. Because if you make an entry into a cap table, but it's not backed up by legal documents, it's not real, or it might not be real. And you want it to be as real as possible in your investment company. So basically what the cap table should do is it should provide a ledger. It's actually capitalization, cap table, these words, really it's a ledger. It's a ledger. It should be a ledger of all your stock grants, all your option grants, all your convertible note issuances, all your safe issuances, all your preferred stock. It should be a ledger. And what the ledger tells the whole story of the company, and it reflects all the underlying legal executed documents. So it should provide you everything you need to know from point one about what's happened with the company. Who got the first stock certificate, all the way down to who got the last one. The purpose of it, well, there's many purposes to it. One primary purpose of making sure you got all the underlying legal documents executed is to avoid any disputes. And I'm sure there are some people on the phone who had problems with disputes. And cap table disputes about capitalization can be one of the more expensive problems to fix. If a company has a cap table broken, it can be very expensive. It can be expensive not only in terms of legal fees, but also in terms of unexpected dilution. No one wants to see their investments get diluted because the company had an unresolved or an ambiguity in its legal documents early on or something. Frequently as investors, what we're going to be looking at and we're going to be focused on is making sure we get the right percentage of the company for the money that we expect. And there's a number of different ways to calculate that. And usually we want to look at it on a fully diluted basis. So if we think we're investing $1 million for say 20% of the company, that everything is counted going toward the 20%, and usually including all the reserve stock options, like unused reserves and future expansive reserves to some limit. Thanks for the slide check there. Getting back to what I said earlier, cap tables should have a ledger of all of these instruments. A few years ago, I had a situation where a company closed a preferred stock round and they forgot about a note. So they had a note outstanding, but they apparently didn't put it on the ledger and they forgot about it. Well, if you've been through these big preferred stock financings that are all negotiated with big law firms or everything else, at the end of that financing, the company only has authorized a certain number of preferred shares into which all the notes converted, and that number gets fixed. And so it turned into a huge nightmare. This company forgot a note. What you would like to make sure as an investor is that the companies basically has good hygiene, has good corporate hygiene in making ledgers of things, like the notes that come in. So yes, notes should be included on the cap table. How does the cap table impact board governance? Well, barring a voting agreement entered into by the company's stockholders, a simple majority of all the voting shares of the company get to elect the entire board. So that is one thing sometimes you see. Sometimes you'll see companies raise money with no voting agreements. And so that's kind of sets forth sort of an interesting future governance dynamic, the potential uncertainty. There's a great story. I don't know if you guys put the hook around me if I'm talking too long, but there's a great story of a Seattle company one time. They had no voting agreement and they had about, say 60 stockholders, and it was all common stock. And the company raised like several $100 million in basically a non-dilutive financing. And then what happened was the company or at least the perception of like more than half the investors was that the management team was squandering the opportunity. And so the company had no voting agreement. All the investors would have to have done is sign a piece of paper saying, we're going to re-elect the entire board to be these people effective immediately and serve it on the company. They could have reset the entire company. So it's interesting to think about the dynamics of not having a voting agreement and control while you look at the cap table. How does the cap table get fixed if there's a problem with it? Well, hopefully as inexpensively as possible. I mean, sometimes you'll find documents people thought were executed weren't executed. And it's pretty easy to get them re-executed. Other times you'll have situations where, I guess another corporate hygiene point for companies is, beware the undocumented arrangements. That, oh yeah, he was working for us and we told him we were going to give him something. We haven't got around to it yet. That's a red flag, because that's the person who comes out of the woodwork and says, hey, give me 10% or something insane. Let's go to the next slide. Maybe
Just
I'll
wanted to back up real quick on the exit, Joe. If you can just talk about, these problems are pretty easy to fix early on when they just happen, but if it waits until the end, it can get real expensive, can it?
Yeah, for sure. It's unfortunate, but in my experience, there's some proportion of the population that sort of looks for opportunities to exploit companies. And so what you'll find is that, yeah, at the exit, everyone who thought they wrote something shows up and wants to get paid. It has some, it's crazy. I did an M&A transaction one time where I spent the whole 3 or 4 weeks we were otherwise negotiating, doing everything else, negotiating releases with people who had claims of one kind or another, or thought they did, on the company's equity. So yeah, it's one of these things you really want to be wise about. Companies shouldn't let anyone come work for them without those people executing the right paperwork. But the right paperwork resolves everything. The way the paperwork exists in the industry, if executed, the right paperwork solves all the problems, so everyone can have certainty.
So Joe, appreciate you giving us a little primer there, and that's one of the big reasons with each of our Keiretsu Capital co-investment fund, we do a legal review, and this is what we check for, and Joe's team spends time, they go through every agreement in the checklist and make sure they're all signed and make sure the cap table's up to date, the board minutes are up to date. And it's one of those things that kind of behind the scenes, under the water, that doesn't get a lot of glitz and glamour, but is very important that, each of the investments that we're making as a community, that, someone needs to be doing the legal review from the investor side of the table. And it's really not that expensive compared to the potential impact if something crops up later. So it's certainly worth it to the company. Make sure that, in fact, when they're completing their angel financing, they do have all their ducks in a row for their future financing, that they've got that foundation in place, and that the reps and warranties, and that, the cap table and what they've said to us is, in fact, what they have agreements behind it to back up. So appreciate all the work there, Joe. I'm going to keep going here with valuation, and happy to take any questions and comments as we go along here as well. So from the investor perspective, the question is, who owns what, and what's it worth, and what am I going to contribute, and what is it going to be worth now, and then what's it going to be worth in the future? And ultimately, it's a lot of economic level descriptions, and the cap table is really where the agreements of the company meet the spreadsheet. And there's a lot of calculations that can be done to really understand, where's the company at, where does it fit within the overall marketplace, what's its stage. How do we determine the value now? How do we determine what the value was 6 months ago? How do we determine what the value is going to be 6 months from now, 12 months from now, 18 months from now? Again, we don't know for sure, but we can have an idea, what milestones need to get accomplished. And ultimately, companies do progress through a similar set of growth points that have specific markers in terms of their valuation milestones in the overall marketplace. So there's a lot of consequences if you set the valuation wrong, and it can have a real positive impact, or it can have a real negative impact. And so the valuation of the capitalization table means different things to different people. And as Joe said, you want to make sure you have an agreement with anybody who's important, anybody who contributes to your company or to a company you're investing in, to make sure it's in writing, because anytime it's not, it's going to create problems in the future. And the valuation for the founders is going to mean one thing as compared to a technology licensee or an accelerator. The first couple checks in are going to be really important to bring that company off on the right path. Early investors, hired management, option holders, employees later on. Ultimately, the bank is going to evaluate the cap table for lending. And then ultimately at exit is kind of the final evaluation of the cap table, is going to be evaluated by the buyer, and they're going to tear it to shreds if they can, because anything they can. And so it's to their advantage to try and find problems with it. on one hand, and then obviously the public market. If a company happens to go public, then evaluating the cap table in that context. So there's a lot of different audiences for the cap table. What we care about as Keiretsu Forum members is, what does the cap table tell us as an investor? And it can tell one of two stories in my experience the last 20 years looking at cap tables. It's kind of like a one or the other type situation, and that's how a lot of these deals are. And honestly, this is how we do a lot of the screening up front, is do they have their cap table organized, and can they even communicate their deal of what they're offering to us? And if they can, it's pretty easy to screen it out and, you know, say, well, obviously this isn't a deal that's going to work. And the challenge is, you know, the cap table can either be, you know, unifying and build trust among the founders and really have a strong group, or it can create a whole bunch of liability. And the most likely outcome for any new founded company is that the company fails in 6 to 9 months because the founders disagree with each other after working together for a period of time, and there's no mechanism for them to work out their disagreement. And so having solid docs at the beginning amongst the founders is incredibly important, because, you know, as we know, these are stressful situations, and it's not often that all the founders progress through the life cycle of the company. And so there has to be a mechanism for addressing that if a challenge comes up, or what people thought they were going to contribute, they may not have been able to. So there's got to be a way of assessing value contributed by the founders and make sure it's fair, and that people feel good about it, and that they're motivated by it. And there's not one founder who contributed nothing that's getting just as much of a take as the founders who contributed everything else. That's very demotivating. And it can either create excitement, or it can be very scary. The company can grow, or the company can shrink, depending on what's happening within its business cycle. We see cap tables that are clear, that are concise, and then we see cap tables that are incredibly complicated and have agreements that adjust based on other agreements that are conditional upon other agreements, and nobody can calculate anything, and everyone just gets confused, and it becomes unmanageable. And just, you know, making sure it's organized and governable. So the cap table kind of splits into two departments, and either you've got the one on the left, which is, you know, what we're all looking for, or you pretty quickly realize it's more likely one on the right. And that, as an angel investor, is a very quick way to screen deal flow, to be able to understand what's going to be worth your time to spend time on. Because trying to dive into these cap table issues and get them fixed as an external investor is going to take a lot of time, a lot of emotional capital, and you will not get the benefit of the bargain for doing so, for the most part, in my experience working with founders. So making sure you at least have a good baseline to get started from, and that there's no self-inflicted wounds to begin with, is very, very important. So once you get over that hurdle, then we're looking at valuation. We're looking at how will we value the cap table. And this gets into a whole marketplace discussion around, you know, how do you determine value, and how do you determine relative value? And there's certain benchmarks and things that we look at. And the stage of development is very important, because angels and VCs are going to be long-term partners invested in these businesses. And the key is having the willing sellers. Obviously, there's lots of companies out there very willing to sell you their stock. The key is convincing unwilling buyers, which is the entire market, who doesn't want to buy their stock unless they develop the trust to become a willing buyer, and hopefully an excited buyer that's going to create momentum within the marketplace. So we always got to remember that equity is the product that's being sold, and the valuation is the price it's being sold for. And so you've got to create demand for the equity, for the investment. And you do that through building trust and through building excitement about the potential of the opportunity. So there's a lot of different stages of development that companies go through. And of course, the risk is extremely high in the early phase of the capitalization of the company. Again, when you just have the founders and a few friends and family, it's a very risky proposition. Any one thing could happen and it could fall apart, and people could lose faith, and people could give up. And as the foundation of the company becomes more solidified, it adds angel investors, it adds sophisticated investors, it adds additional management team members as it progresses its business, as it generates revenue, and it reduces the risk. The risk is still very high, because lots of bad things can happen in the market or otherwise that can still throw the company off. But as it progresses through the rounds of development within its capitalization, it becomes a more solid foundation to build off of, and people have more trust and more faith and are willing to bank on that foundation. So the key is to make it a very solid foundation, and that's something we are very interested in with the Keiretsu, is to make sure that the foundational development of our companies is very strong, and that adding angel investors to those foundations makes them even stronger. And then adding family offices and other long-term investors makes them even stronger to support the companies through the good times as well as the tough times. So we could do a whole session on how to determine the valuation of a company. These are some of the rules of thumb that I picked up from my 20 years of evaluating companies and really looking at it from two levels. Number one is the ground up. What assets does the company have today? Do they have a strong management team with a track record? Do they have a financial model that they believe will deliver them profitability? Do they have the potential to sell? Have they sold before? What kind of intellectual property do they have that prevents other competitors from competing with them on price and reducing their margins? What are the investment terms? Are they offering attractive terms that are likely to get financed? And then as I look at the capitalization table, what percentage of this cap table is excited about this company going forward and are going to put an oar in the water and help build the company? And my rule of thumb is that you need at least 80% of the cap table on a go forward basis. And if you have more than 20% dead weight, it's going to really diminish the potential achievement level of the company. And so those are all things to be looked at and addressed, to make sure everybody who owns stock in an angel-backed company should be very motivated to support its success going forward. And if there is a technology licensee or something that was acquired, that should be maybe 20% of the initial founding value of the company, but 80% should be the management team, the advisors, the board, and the investors on a go-forward basis. And that's where we get to the allocation amongst the investment rounds. And then we got to look top down. If you want to hit a high growth company, it's got to double in value every 18 to 24 months to get 10x in 5 years. And again, that's not going to happen most of the time, but we'd like it to be able to happen. So, you're looking at a 50% discount, 60% discount rate, per year of growth in order to be able to hit that level. And so you've got to think about the return requirements and how much capital is needed in order to be able to at least get a shot of being close to that food chain. And most companies, it's going to take twice as long and cost twice as much. And if you originally price it along these lines to get 10x in 5 years, and it takes twice as long and costs twice as much, you're still going to make money. And that's the key. You got to build in to your valuation the fact that, these things take a long time to ultimately come to fruition. So you've got to be realistic when evaluating the cap table up front. If you set the valuation too high too quickly, it's going to really demotivate folks from coming aboard and wanting to support the company. And it's a very competitive market for angel capital. While there's tons of wealth out there, most of them are unwilling buyers of any cap table we look at. There's easy to find red flags and challenges with any early stage companies. It's easy to find reasons not to invest. And most people who do investing lose money. So the key is that you're competing amongst a group of willing buyers, and you've got to convince them to trust you relative to others. And that's the real competition when it comes to the marketplace. And that's why the due diligence is so critical. Because again, getting all those checkbox items, making sure your hygiene and your cap table, these are the easy things to do to make sure everything's in place and ready to go for your funding round. You want to be focused on the market opportunity, not focused on why the cap table's broken and the math doesn't work. So this is a lot of what we try to do with Keiretsu and helping our members to be able to be involved with our companies and to get them structured in a way that is financeable, and handle that in the screening up front so that we can be very productive around our investment activities and make sure that if in fact we get a good result, we're likely to get a good funding result. So of course the pre-money needs to add up all the collective value, the asset value of the company to date. So any cash that's been put in, any sweat equity, make sure that that's documented and that it's contributed in the proper way. Any intellectual property that's been brought in. Obviously, hopefully you got a great idea for a good market and a good product. It's the sum value of all that. So that's going to equal a number. And that's going to be divided by the number of shares. And that's going to give us a share price. And it's become a lot more complicated now to calculate the post money, because it used to be you had the pre-money, you added the cash invested, and then you'd have the post money. But as we've seen over the last 10 years, there's been a huge proliferation of what we call dark matter. And these are agreements where capital's been invested, but it's conditional upon something happening. So it's not quite equity. So it's not quite counted in the fully diluted capitalization of the company. These are safe notes, convertible notes, and other types of convertible securities, which also convert along with the new money to, in some cases, dramatically increase the post money of the company. And so this is a lot of what we look at in due diligence to make sure we have the math properly calculated so that we can calculate exactly what our ownership is going to be, and then look at what the convertible instruments are going to be and look at what we're going to end up at. So we put together a tool called a cap table worksheet, which I use to advise companies and investors on deal terms. And what the benefit of is that the math is the math. And credit to Joe, regardless of what the lawyers say, Joe's much more of a straight talker than many of the company counsels that we work with, where they seem to think that the math isn't the math, that the math is what, you know, they want it to be. But the benefit of math is that it doesn't lie, and it provides all the data right there to write the term sheet against. And as long as you have a spreadsheet with your term sheet, you're going to be in much better shape than if you just let them decide what the fully diluted capitalization is and what the definitions of those things are. So ideally, we were able to put it all in a spreadsheet so every investor can see where they're going to end up, what percentage they're going to own, and that the entrepreneurs have a tool to be able to do some scenario planning, to be able to say, well, if I price my round at 4 million, you know, here's how much I give up. But if I price it at 3 million, well, I only give up 3% more. So by decreasing the valuation of the cap table by 25%, it only costs me 3%. You know, they can make that valuation judgment as to how hard do they want it to be to sell the stock in the marketplace. Because again, the higher you charge a price per share, the harder it's going to be to sell it relative to the other opportunities. So we find that's very beneficial for both the investors and the entrepreneurs to come to common ground and come up with a fair deal and really understand what the impacts of that can be, so that the companies become much more fundable. So I'm a little bit scheduled here, and I wanted to bring up Francesca from Carta for our 11:30 update, and then I'll jump back to some of our cap table worksheets in just a minute. So Francesca, thanks for being here. We'd love for you to just spend a minute and tell us a bit about Carta, which we've standardized on from a Keiretsu Capital and Keiretsu Forum point of view. We encourage all of our portfolio companies to use an electronic cap table for all the efficiency that it provides. Carta, originally eShares back in the day when Henry got it going, has progressed, you know, definitely the furthest as a big leader in this market, and appreciate your partnership with us and support of Keiretsu, and love for you just to talk a few minutes about Carta and what are electronic cap tables and electronic shares, and how does that work compared to what was, and, you know, where do you guys see the future going that angel investors should keep an eye out for?
Sure. Thanks so much, Nathan. So as Nathan mentioned, Francesca Puccinelli, I am with Carta. I've been at Carta for about 3 years. So joined just when they actually started raising for their Series C. So has been a really, really fun time to see the company grow and scale. And of course, along the way, we've worked with a ton of investors and a ton of different law firms to really bring everybody and enable everybody to understand how Carta can benefit you. So I would say, you know, before Carta came onto the scene, probably even as soon as 5 or 6 years ago, all securities, whether that be a certificate, whether that be a convertible note, everything was done offline. And instead of getting, you know, an email to signify that you have a security, you got a paper certificate. So Henry Ward, our CEO, and his co-founder Manu Kumar, who's at K9 Ventures, came onto the scene and they saw a really huge gap between the private markets and the public markets. So we first started off with cap table management, that first little blurb that you see there. And then we just started expanding our services on and on. So now companies today can access Carta for cap table management. They can get 498 valuations. Liquidity, we're coming out with Carta X, which is our venue for secondary trading. That will be out hopefully sometime in November. That's definitely a bigger conversation, but essentially we'll be running company-driven secondary transactions. We'll still be able to do tender offers and things like that, but this will be a little bit different. You can check out more about Carta X on our website. And really wanted to hone in on the market to help founders and also help investors to make everything digital and make everything a lot more accessible. So for you as angel investors, you want to definitely, if you have companies that you're investing in, having standardization and having things electronic will make your lives a lot easier. So when you're working with a company, there's a couple of different offers that Carta provides, and something that might be really useful for the companies that you're investing in, especially if they're on the smaller end, is we have a program called Carta Launch, which is a free version of Carta for companies that have less than $1 million raised and under 25 stakeholders on their cap table. So from here, if you're working with a company, maybe they're seed, maybe they're pre-seed, you can ask them to utilize Carta Launch. And Nathan, I'll pass along some information about Carta Launch to you afterwards, but anybody who's interested can shoot me an email and we could definitely get companies started. But really this really lowers the barrier to entry to allow companies to issue electronic shares and also make sure that they're staying on track. So one thing that we see, especially with really early stage founders, and Nathan, you might have already touched on this, but with early stage founders or maybe even first time founders, they oftentimes have a lot of trouble staying organized. And what we always say is the cap table at the very early stages can be very, very simple, but it can get complex really, really fast. So for example, if you're working with a founder that's raising convertibles or raising safes, they're running around, they might have gotten some information from their law firm and the law firm said, here's our standard form, now go out and raise money. They're running around, they're talking to a bunch of different people, and they might have signed off on safe agreements, they might have signed off on convertibles, and they put that in the back of their head. They got the money, it's secured, it's in their bank account, but sometimes they don't put it in their cap table. So what we always say is the earlier the better to get started on some sort of system, and things, as I mentioned, can get complicated really, really fast. So definitely something to recommend to founders that you're working with. I would say a lot of institutional investors or bigger VCs have put within their side letters to, hey, you are required to be on Carta in order to make this investment go through. So we're seeing a lot of that in the market sometimes. And we're also just seeing a lot of investors preferring Carta just because it can really make their lives easier to manage their entire portfolio. So that's just a little blurb about Carta. We definitely want to start working more with our angel investor community. I think that's something that we haven't done a ton of before, and something that we're really looking forward to doing, especially in 2021.
Thanks so much, Francisco. We appreciate you being on to share a little bit of the background about Carta. And it is very exciting because the angels definitely make a marketplace. And when we talk about that liquidity, it's a little tougher with the funds because they want to invest. But in terms of creating an actual market with liquidity, the broad base of the angel community and groups like Keiretsu and other angel organizations, you know, we have the global community, but having the platform like this to be able to operate on would be very helpful for those follow-on rounds, syndications, being able to track everything and make sure everything's up to date. And as Joe mentioned, you know, one of the great things about Carta is that it's not technology. It's in fact a whole bunch of accountants as well that really care about making sure the technology actually reflects the underlying agreements. And that's a little different than some of the other online technology platforms that offer this service that you don't quite see right up front. But when you get into it, again, Carta's evaluated every single one of our 170 investments we've made with Keiretsu Capital, and they have somebody read the agreement and code it up and put it in the system and make sure it in fact reflects what was agreed to. And then, you know, there's updates that have to get made because, you know, sometimes a warrant gets missed or other things get missed. So it's a constant process, but I would put a plug in for Carta that's as much human driven as it is technology driven, and having the right combination of the two cultures is something that they've been able to do very well to make sure that, you know, if you have a complicated transaction, if you have a company that needs to get cleaned up and they have a whole bunch of safes and they haven't accounted for anything, Carta actually has a deal team and they will onboard everything and they will go through the process of making sure, and they're going to be a lot more inexpensive than having the legal counsel do it. So but that's going to maybe talk about just some of the services that you guys offer for angels or for companies and some of those kind of deal opportunities and things you guys are working on there. If people want kind of a concierge type service, you know, how do they find out more?
Definitely. So on the angel side right now, depending on the size of, if you are part of a more broader fund, that's definitely something we can help with. On the investor side, we do fund administration and 820 valuation. So that's more services on the fund side. Something that we just rolled out in 2020 is we're also doing, and this might be less relevant and more relevant for folks that are part of the LP community, but we do capital call loans. So we have a partner bank that we're working with. So far it has been tremendous outpouring for a lot of our customers. So that's something that we rolled out this year. And then on the company side, we're doing basically everything that you're seeing here: cap table management, 498 valuation. So that's for the companies to help them stay compliant, and you know, they'll have to do that every 12 months to stay in safe harbor. And then another thing that we're coming out with late October, this is just a little preview. I saw some of the questions that came through, but starting mid-October, we'll have the ability for founders to actually raise safes on Carta. And the first iteration will be primarily similar to, you know, a DocuSign. So right now, how it works in Carta is usually the safe transactions will be sent in Carta, but you know, there's not a ton of information to be about the wire instructions, things like that. And going forward, founders will be able to send out information to investors to allow them to, one, send those documents right off the bat. You don't have to do any double entry. That will all happen directly in Carta. And then two, we'll be able to pass along the wire instructions from the company into the investor so that that process is a little bit more streamlined. And then future iterations, of course, will hopefully be able to do that via ACH so that those transactions happen pretty seamlessly and Carta can confirm the funds. So stay tuned for that happening mid-October. We're really excited about that. We just brought on a team to kind of handle those sorts of types of products. So stay tuned. We're really excited about that going forward.
All right, terrific. Thanks so much for being with us, Francesca. We're excited to continue to work with you guys and refer our companies and investors over. So appreciate you being with us to give us a quick update. Thanks.
Thanks, Nathan.
So I'm just going to jump back to where I left off in terms of the cap table worksheet, and then I've got a quick example before I turn it over to Nate Foose to run through dilution impacts on the cap table, and then we'll open it up for Q&A at the top of the hour. As I mentioned, the goal of the worksheet is to really put everything in one schedule, one spreadsheet, to be able to see everything all in one spot. So the first example that we've got here is a company that I structured a few years back, went on to raise significant funding based on everything we put together. But when we got started, they had 3 different safe notes. So much like Francisca described there, Bay Area company, 3 different safe notes with different caps and discounted amounts. And they were trying to figure out how to get all this converted over and get a Series seed round done. And so this spreadsheet, basically provides the opportunity to put all the financing and the founders, account for all the shares, and then look at what the post-money valuation of the whole exercise will be upon completing the different rounds of funding. And then looking at ultimately how much of the funding round gets sold. And then you can adjust the parameters accordingly to see what the different outcomes would be at different valuation levels. So the entrepreneurs can understand how much of a percentage they're giving up when they change the pricing. And oftentimes we find that the entrepreneurs don't appreciate that to go from an 8 million valuation to a 6, it's actually only usually a couple % difference, but it certainly makes the fundraising a lot easier the more aggressively that you price the company. And so this type of spreadsheet, if you map it out and add in a Series A on top of it, this particular company was going after a venture-backed track. So they had a number of follow-on rounds that were going to be done. And so they wanted to kind of run through and look at the analysis all the way through a Series B round, raising a total of 44+ million, and what the impact of that would be on their capitalization and what the returns for each of the investors would be that participated in that particular financing. Again, just a quick snapshot here. Example 2 is a deal in the works right now. They've got currently 6 million of debt. They did an A round before, and they're looking to price a new note, and we'd encourage them to do a priced round and get the debt converted. They wanted to grow the value of the company in an effort to max out the caps of the current notes that they had. And so this is a helpful example here where you have a whole bunch of convertible debt. And we had another example of this where they had 5 years worth of convertible debt, 9 million in total that ended up converting. And as you can imagine, that has a big impact. So for the first note here at an 8 cap, it pretty well the math works and the valuation is 8. But once you keep layering additional notes on and years go by and this money's spent, you got to look at what the impact of the conversion of that's going to be on the valuation of the company. And so by adding the original stock plus the converted shares of the initial round, we can actually come up with what the implied pre-money value would be today for, in this case, the notes that just happened, and then look at what we would be paying if we came in at a new note right now. And then multiplying it on out, you look at if you ratchet up the valuation of the future priced round to the point where the second round of notes caps out, you can see where the valuation there would be. And ultimately you go from a post money of about 28 million to a post money of almost 40. So it's up about 12 million, but the difference in terms of the valuation dilution effect for the founders is less than 4%. So it costs the founding common and Series A holders 3.8% if they wanted to go from a post money of close to 40 million down to a post money of 28 million. So the question they've got to ask themselves is that, is that worth it? Because obviously it's going to make the funding easier if they end up dropping their valuations down. So these are some of the tools that we use to evaluate the cap structures of companies in order to give ourselves all the information in one spot. We can manipulate the information to be able to come up with different examples of how the debt could convert based on the agreement of the parties or future financing rounds. And the goal is to give everybody, a clean set of information in order to be able to come up with a deal that's going to work for everybody. So we've got a example here, which we'll run a poll against. So which option would you choose? So we've got option A or option B. So option A is a situation where you're raising a Series A round. You've got a pre-money of $3.5 million. You're able to raise $4 million. Your post is 7.5, but you give up over half the company to do so. Or option B, you get a higher valuation, $4.5 million, but you only raise half as much cash. So you only get $2 million instead of $4 million. You end up keeping almost 70% of the company. So if you were the entrepreneur, if you were the angel, which deal would you prefer to participate in? Would you rather get option A or option B? So take a minute, vote, and then we'll reveal the results and see the discussion that can come from that. And, you know, at these early stages of company development, it's very critical. And cash is definitely a big lifeline. So we'll give it another 10 seconds here or so for everybody to vote real quick. Looks like option B is in the lead here. So we got 20 voted. Got a few more to go here. Then we'll, a few more votes coming in, so we'll leave it open a little longer here. All right. 5, 4, 3, 2, 1. So share the results there. We had 20 go for option B, 77%. So if we move forward and look at the results of what actually happened in this real world scenario, the extra cash that option A raised allowed them to be able to execute much further, get their product further into the market. And so when they came to their next round of funding, they had product market fit. They were able to get a much higher valuation. Whereas unfortunately option B, $2 million just wasn't quite enough to get to the milestones they needed. So their valuation on their B round ended up being just $20 million. So having raised $15 million more, ultimately the wealth of the entrepreneurs and of the investors in option A ended up being substantially higher. So the key here is that cash is king for these early stage companies. And, you know, valuation is really nothing if you don't have the money to execute the business. And so a lot of times we say, well, you know, yeah, the cap table will be worth that much, but you've got to have the $3 million in the bank. And so what's the valuation before and after is really an important consideration. You know, what's the company worth with the money versus what's the company worth without it? And, you know, all these things are risky and difficult, but if you don't have the cash, you're not going to be able to perform optimally and compete in these markets that are very important. So, you know, it's really important that you have good counsel, that you have a clean cap table, that you make sure all the interests within the cap table are aligned, and be realistic about valuation and appreciate, you know, what you're getting for what you're getting up, because the goal is to grow the pie. And the beautiful thing about angel investors is that they want to help, and they want to be more than just capital, and they have networks and they have connections and things that are very valuable. So oftentimes the entrepreneurs are willing to, you know, give up a little more because they're obviously getting more, because they're getting a whole network of support and syndication and risk reduction benefit that otherwise would be much more difficult for them to build on their own. So that's why it's great to work as part of a group and to be able to work on these cap tables. So with that, I'm going to turn things over to Nate Foose. Nate, if you're ready to share your screen here, I'll go ahead and stop and let you share to run us through some of the dilution slides that you've got as examples. It's a big part of our due diligence is what is the follow-on funding requirement, because obviously that's a big risk factor. If the company's burning hundreds of thousands in cash and needs money, it's going to be in a very leveraged position. Angels generally are more pragmatic. We like investing in companies that don't need to raise huge amounts of money because we don't have hundreds of millions to invest each individually typically. So, but dilution is a key variable in valuation. And the more dilution a company needs, the more, even more aggressive we need to be about negotiating the cap table valuation up front. So Nate, you want to run us through some examples that kind of showcases that a bit, and then we'll jump into Q&A at the little past the top of the hour.
Certainly, thanks, Nathan. So yes, as Nathan mentioned, I'll run through just a couple of really simple examples, hopefully to kind of outline how, some back of the napkin math around how you can look at cap tables as you prepare to invest in a round and consider some of the valuation and dilution questions and their impact on the cap table. A lot of this is going to start veering, I think, into how we value companies, and I want to emphasize that the value of understanding how companies are valued is really understanding how that valuation impacts your position on the cap table, the company's position on its cap table, and the positions of future and past investors, and how those are all interrelated. So a lot of interlocking themes there. So just to kind of set the groundwork for what will be our first example here. We've just got a sample company, founders own all of it, and they're going out to raise their first round of capital. So we get to what we're going to call the Series A round. The founders are raising $500,000 on a 2.5 pre-money valuation. Now, in the simplest scenario, the post-money, as hopefully everybody knows, is just to take the pre-money, add how much the company is raising, and that's going to be your post-money valuation. I do want to point out here that you want to be a little bit careful, and this is why it's important to read the cap table, read the term sheet, and read the balance sheet so carefully. There are some companies that will try to include prior convertible notes into this as well, in which case you would get a pre-money plus the raise plus existing notes equals the post-money. So, sometimes companies do some funky things with this. So just make sure that ultimately what you care about the most and what affects your position on the cap table is the post-money valuation of the current round. And of course, as hopefully everybody knows, to calculate your percent ownership in the current round, you simply divide what you put in by the post-money valuation. In this case, we see that gives our A investors who put in $500,000 on a $3 million post, 16% of the company. And of course, then founders get 100% of what's left, or 83%. And we can play this out over a few more examples here. For example, in a Series B here, we might have the company raising $1 million on a $5.5 million post. And again, the math is very similar. The new investors get their raise divided by the post money. The Series A investors, the prior investors, get 16% of what's left. So they get 16% of the remaining 81%, which leaves them with 13% now after round 2. And founders similarly get diluted. So if we play this out, let's say that this company had an A, B, C, D, E round, so 5 rounds of fundraising in total. And this is what we refer to as dilution. Everybody gets diluted for the most part pretty equally, absent any sort of protective provisions, and that's another thing to watch out for. But the more that a company raises money, the lower your percentage equity stake in the company is going to be. Although, as Nathan's examples pointed out, that doesn't necessarily mean that your slice of the pie has shrunk. It may have shrunk as a percentage of the total pie, but if the entire pie is bigger, everybody is potentially better off. So this kind of, the common question that we get a lot is when you're looking at a cap table and you see investors getting diluted, you see the potential for yourself to get diluted as the company continues to raise additional rounds, continues to add new investors to the cap table, expand their option pool for employees. Is that dilution a bad thing? So in this example here, let's say this company exited for $200 million and you had 7% of the company left at time of exit for 28x. And this math is just using the previous cap table that we saw before. So is this good or bad? Now, if you were expecting that you were going to keep your 17% of the company all the way to exit, this is of course not great. You only ended up with 7% of the company. But if you expected that, and this is why it's so important to work through some of these cap table examples, this back of the napkin math as you're getting ready to invest in a company. If you looked at this company and said, hey, I think this company is going to require 4 more rounds. I think I'm going to get diluted, 10 to 30% each time. And you were expecting that you were going to end up with about a 7%, then you're really no worse shape off than you expected. And of course, if you were kind of the traditional investor looking for a 10x, you actually, still did better than expected despite the amount of dilution that occurred here. So this is all just to say, make sure that you're doing these sort of back of the napkin numbers, that you're modeling out some of these scenarios, and at least kind of in the back of your head, keeping in mind, all right, how many rounds do I think this company still needs to raise? And how much do I think I'm going to get diluted at each stage? To give a couple examples as well around how we look at convertible notes on the cap table, since that's also something that comes up a lot. So in this case, we're going to replace that first round with a convertible note. So the company is going to be raising $500,000 on a 4 million cap with a 20% discount. And again, hopefully everybody's familiar with convertible notes. You of course use the cap if the next round comes in higher, and you use the discount if the next round comes in lower. And the point of that discount is to reward the early investors for taking that additional risk before the company has met more of its milestones. Most importantly, a convertible note is debt. It is on the balance sheet. It is not on the cap table as equity. So when you hold a convertible note or a safe note or any sort of convertible note like that, you don't have equity in the company. And that does come with some tax and governance implications. As a debt holder, you are protected a little bit in the event of a liquidation or bankruptcy, but you do not get to participate in the governance of the company. There's some tax implications around the timing of when you actually hold shares. So that's something to think about in looking at a convertible note round. To look at how these convert and how that plays out on the cap table, we can see here that the company has raised its next round at a valuation higher than that 4 million cap. So we're going to go ahead and use the 4 million cap here. Now the note holders, if you think back to the prior round, they invested $500,000. That's going to convert into that 4 million post-money cap for 12.5% of the company. And then the math is pretty much the same for the other investors. The A round put in 1 million on a 10 million post-money for 10%, and then the founders get what's left at this early stage. To give a little bit of a different example, the flip side of that is, let's say that the company actually raises at a pre-money that is less than the cap in the next round. So in this case, 2 million is less than 4. So we're going to ignore the cap in this case, and we're going to apply the 20% discount. And there's a couple of different ways to do the math. And again, as I'm using these examples, I'm using percentages instead of numbers of shares, just to try to keep things consistent across companies. So in the spirit of continuing to do that, what I usually like to do is just look at what it would be if you had invested at the Series A price. So if you take that Series A price of a 3 million post money and imagine that you would put your $500,000 into that, you would have ended up with about 16% of the company, just looking at your $500 investment divided by the 3 million post money valuation in the current round. And then you're going to apply a 20% discount to that. So instead of only getting 16% of the company, you're actually getting 20% of this company. And that's where that discount rewards you for coming in earlier. Because the company didn't quite grow enough to exceed the cap, your reward comes in the form of you get a 20% cheaper price than current round investors. So as we wrap this up here, I want to talk a little bit about where these value numbers come from. I've seen a few questions in the chat about that. So just to touch on that a little bit here. There's a few just very simple rules of thumb that you can use as sort of a gut check for, do things make sense? Do things seem reasonable? And you can look at just simply the amount the company is raising. Most companies will typically sell about 10 to 30% of their equity in a given round. 20% is pretty common, and then give or take 10 depending on how badly and how quickly the company needs its cash. If the company is really hurting, it might have to offer investors more equity. If the company can afford to shop around a little bit, they're not going to have to offer investors as much equity. So it's really a supply and demand sort of negotiation here. And you see that reflected as well in just comparing companies with what other companies are doing. If I see 5 widget companies and they're all raising at a 5 million post money, I would expect the 6th widget company that I see to be at a comparable level unless they've met particular milestones or have yet to meet particular milestones to justify a higher or lower valuation. And of course, we also want to be aware of what's going on in the public markets and make sure that kind of the risk reward supply-demand negotiations reflect those changes. You can see from our prior examples here, I kind of modeled it after these rules of thumb. We had the company selling, about the right amount of equity in each stage. One thing I do want to point out here is that it's really important not to get too hung up on what rounds are called. And this is, again, where the cap table can be very helpful to understand the history of what's happened. As Joe put it, sort of the shadow imprint of everything that's happened to date. You might be looking at this and you might think, gee, a 3 million post money seems low for an A round. A 5 million post money seems really low for a B round. But again, what's important is to look at just the history of what's happened, the timeline of what's happened. Companies can call their rounds whatever they want to call their rounds. So don't let yourself get bogged down in sort of a catchy terminology. Don't let yourself be flattered by a company saying, oh, we're just going with an easy $1 a share, or we're going with a Series A, a Series B, a Series C. Really look at the cap table, really understand what's actually happened, where you fit in, and where you expect the company to go from here. The final thing I'll point out, or the final thing I'll touch on here when we're looking at valuation before we move into Q&A, Joe mentioned earlier a quote from, I think, Peter Thiel, that investors really are looking at valuation today as a discount of future value rather than as any sort of intrinsic present value or reflection of the balance sheet book value. So, really my way of always looking at is a valuation reasonable is looking at comparable exits. What have similar companies exited for? And I'll give an example briefly after this to kind of explain how you can use a cap table to estimate and look at what your share of that pie is going to be. So of course, the first thing you're going to want to do is understand, what do I think this company can exit for based on what similar companies have exited for, and then adjusting that as necessary. You of course then want to discount it back for the amount of future rounds you expect, any additional risk beyond that dilution risk. And then you just want to understand, how much do you want to make on your investment? How much is reasonable for you to expect to make on your investment given the level of risk you're taking? And then calculating pre-money from there is a pretty easy step. So I'll quickly walk through this before we wrap up here. Just to kind of explain, even if you don't want to dig into the weeds on a particularly meaty cap table, even if you don't know a lot about the cap structure or where the company is going, you really just need to know a few things to estimate your current valuation terms. So in this situation, we know that the company is raising $500,000. We know that similar companies have exited for $200 million. And we know that we want a 30x return. Let's say that we're investing very early. We're in that friends and family round. We're taking a lot of risk. What this means is that at the time of exit, if I put in 500 million, or excuse me, if I put in 500,000, I need to get about 15 million back. From there, it's a pretty simple metric of if we expect this company to raise capital in 5 rounds and we expect to be diluted about 20% each time, we can walk that back pretty easily to see how much do we need to own at exit, how much do we need to own now, and then pretty easily do those calculations to determine what our post-money needs to be and back it out to get to what the pre-money needs to be. The final point I'll make here is that as part of a group, it's important to remember that terms can always be negotiated, and one of the benefits of a group like Keiretsu is that there are lots of us. So even if individually we're writing small checks, make sure that you're banding together with other people writing those small checks so that you can throw your weight around a little bit, make sure that the terms are favorable. If the cap structure is a little bit convoluted, if interests are not aligned, especially among the founding team, especially among people on the board and investors, if there's a lot of outstanding notes that need to be converted but aren't going to be, that's the time to really have a conversation with the company, do some gut checks on the valuation, and make sure that the cap table makes sense and that you can fix things if they need to be fixed. So from there, I think we're on to Q&A. So I'll stop sharing my screen now so we can go back to any slides that we need. Otherwise, I'll turn it back over to you, Nathan, to get us through Q&A here.
All right, thanks, Nate. Great job with that. We'll open up for questions. So if folks have a question, raise your hand or take yourself off mute. And John, go ahead and get us started, John Stinson.
Oh, I was just wondering if we can get copies of your slides. Some of those would be helpful to put some notes on for future reference.
Yep, we have the recording and the slides, and we'll definitely make those available to everybody, so for sure.
Thank you. Thank you.
Any other questions or comments? Just raise your hand or take yourself off mute. Mark?
Hey there.
In evaluation, go ahead and jump on in, bud.
What's that? What's that? Say that again.
Our Grand Poobah evaluation.
Oh, I don't know. Maybe. I mean, I'm always, it's the terminology that gets me. So it's like, I think a good job on taking a pretty complex topic and hitting the high points. I think like the way the word valuation is used is never accurate. So this is really pricing and market price or market value, and really value of capital, right? Versus really the value of a company. So I think one thing that would help me, having spent too long in my life trying to figure out the value of a company, is how do you actually link together the value of the company? Because by this sort of methodology, you're saying, okay, all companies that are in Series A should be worth 3 million, or all companies that are in Series B should be worth this. And you're working backwards from that. So like, what real company specific risk are you really tying together? So for example, if the company like is not hitting its milestones, like by this view, I can see how I've invested in some companies that said they were at 200 million and they never got there, but the capital kept going up and up, and the pricing of the company kept going up and up because they never tied it to anything like revenue or profits or basic valuation metrics, not capital pricing metrics. So if you could talk a little bit about how you link those together, the company value, and Nate said it pretty well, like you're not linking this anything to intrinsic value. So I'd like to understand the link between the two.
Yeah, it's really an option price on future value, and is kind of the high level way to look at it. You know, again, depending on how much more capital they need, and typically with our angel backed companies, they're not looking to take a bunch of dilution. That's why angels like them. So it makes the math a little easier if they don't have to raise 100 million more, you know, and you got to factor all that in to what it will turn out to be. So it's, you know, if you look at the average angel financing in the United States, the pre-money is about 2 million. And that's just a factor of risk capital. And the most common round of funding is like 300K at, you know, 2 million valuation. So if you take the Silicon Valley kind of out of the statistics of the United States and North America, it definitely helps to understand the numbers a little more rationally. There's so much supply of venture capital in the Silicon Valley that obviously it has a distortive effect because there's so much supply of capital relative to the demand by entrepreneurs that actually have good ideas and have good potential behind them. So each sub-market also has its own